How France still controls and prints money for 14 African countries and keeps the change. On December 26, 1945, in a Paris still smelling of smoke and damp stone, a clerk stamps a document and the ink dries like a verdict. We think Africa's story after independence is about flags, speeches, and soldiers leaving. That is the postcard version. The real story sits in a ledger, inside a balance sheet, where sovereignty can be reduced to columns and signatures. People say empires died because the world grew moral. They say France left because it was tired, broke, or ashamed. That is comforting fiction. France did not lose its African empire in a war. It rewired it through accounting, and it learned to profit without wearing a uniform. Because the fastest way to occupy a country is not boots on the ground. It is control of its money. It is the quiet power to approve or deny liquidity. It is the authority to decide whether a nation is solvent or pushed into insolvency. In the late 1950s and early 1960s, the parades came on schedule. Brass bands, new anthems, new presidents in crisp suits with sweat shining at their temples. Cameras loved those moments because they looked like closure. Gold braid on uniforms, fresh paint on government buildings, fireworks over capital cities. The world clapped and told itself the bill had been paid, but the bill was only moved. Behind the stage, another document stayed alive. It sat in a drawer like a loaded pistol. A currency system built to outlive governors, generals, and slogans. A system that did not need permission from voters. At France's peak, it sold itself as a sunlit republic with a civilizing mission. You can almost hear the rhetoric in old radio recordings. It sounds like marble halls and clean intentions. But empires are never funded by ideals alone. They are funded by cash, commodities, and credit. They are funded by ports, rail lines, and insurance contracts. They are funded by a ledger that knows no poetry. In the old empire, Africa was not just territory, it was collateral. It was the guarantee on France's recovery and prestige. It was the quiet reservoir of resources that kept factories fed and balance sheets breathing. Then the world shifted after 1945. The old empires looked heavy, expensive, and dangerous. Too visible. Too politically toxic. A new model was needed, one that could hide in treaties and banking rules. So France built a machine with 4 simple instincts: hold the reserves, set the exchange rate, control the channels, and keep the printing press close. It did not look like conquest. It looked like stability. The name on the paperwork was the CFA franc. In 1945, it was born as a colonial instrument, and it carried the smell of the era. Later, the acronym was cleaned up and rebranded. The suit changed, the body stayed. This is where the illusion of majesty breaks. Because political independence without monetary independence is theater. The crowd hears freedom. The ledger hears leverage. Think like an accountant for a moment. What is a currency, if not a promise backed by reserves? What is a central bank, if not a gatekeeper of that promise? If the reserves sit elsewhere, then the promise is rented. Now meet the addiction. It is not cocaine or alcohol. It is convertibility. It is the sweet, dangerous comfort of a fixed peg. The kind of stability that feels like safety until you notice the leash. A pegged currency is a contract, and contracts have winners. In this contract, the African states get a stable note. France gets influence, visibility into reserves, and a system designed to keep capital flowing outward. The monster in this story is not a general. It is a mechanism. It feeds on deposits, on compliance, on fear of volatility. It grows fat when leaders choose predictability over freedom. And the antagonist is not one man in a palace. It is a creditor mindset. It is the treasury logic that says, if we guarantee you, we can supervise you. It is the cold smile of a banker who calls control a service. Here is how the trap feels on the ground. A farmer sells cocoa or cotton. A state exports oil, timber, uranium, coffee. Hard currency arrives from abroad, and that is oxygen. That is the ability to buy machines, medicine, and fuel. But under the system, large portions of that oxygen are routed away. Not with guns, with rules. The money is placed where Paris can see it, measure it, and influence its use. Even if you never read a treaty, you can understand the psychology. Imagine earning your paycheck and being required to keep it in someone else's account. Imagine paying for the privilege of accessing your own cash. That is not partnership. That is custody. The second hook is the peg itself. A fixed exchange rate looks like discipline. Low inflation looks like competence. But a developing economy often needs flexibility, not a corset. A strong currency can be a silent killer. It makes exports expensive and imports cheap. It tells local factories they are too weak to be born. It turns entrepreneurs into beggars at the bank door. Let that number sink in. In this system, the exchange rate is not a reflection of local productivity. It is a political setting. It is a thermostat controlled outside the house. Then comes the third lever, capital movement. If profits can leave instantly, then wealth does not compound locally. It bleeds out. It becomes dividends in another city. It becomes real estate far from the mines and farms that produced it. And the fourth lever is the printing itself. Banknotes are not just paper. They are symbols of authority. When the printing press is offshore, it is a reminder that control lives elsewhere. This is the part people miss because it is so quiet. The system does not need constant violence. It only needs the credible threat of financial suffocation. It needs leaders to believe the door will close if they misbehave. So the story becomes a chronological spiral, the kind every noir detective knows. A man thinks he is free. Then he finds the fine print. Then he learns the fine print is the real law. By the early 1960s, the independence ceremonies played across the continent. But the financial architecture remained anchored. The old colonial channels were now dressed as cooperation. The paperwork was diplomatic. The consequences were brutal. When a country cannot devalue freely, it cannot easily protect its industries. When it cannot expand credit on its own terms, it cannot finance growth the way fast-developing states did in Asia. It must stay polite. It must stay liquid. It must stay small. Here is the rule of three in financial form. The reserves were constrained. The credit was conservative. The exchange rate was locked. That is how an economy is slowed without firing a shot. Now the timeline delivers its warning stories, told like street legends in ministries. Leaders who tried to break away learned that the penalty was not only economic, it was political instability, sudden isolation, or worse. You do not need to believe every rumor to understand the logic. A currency system creates dependency. Dependency creates leverage, and leverage attracts enforcers. Then came the moment that proved the guarantee was not love, it was conditional. In January 1994, the CFA franc was devalued by 50%. Overnight, the purchasing power of millions was cut in half. Think about that in human terms. A family saves for school fees, rent, medicine, and food. Then a decision lands like an axe, and the same savings buy only half. That is not a statistic. That is hunger with a date attached. A devaluation is often described as policy. In reality, it is a liquidation sale of living standards. It is the kind of act that reveals who holds the keys and who does not. In that moment, the mask slips. If the value of your money can be halved without your consent, then it was never fully yours. You can vote. You can sing an anthem. But your wallet is still governed elsewhere. And then the euro era arrives like a second twist of the knife. France gives up the franc and joins a larger European currency project. Now the African peg is tied to a currency France itself does not fully control. It becomes a strange hierarchy. African monetary life is now indirectly linked to decisions made for European needs. Interest rate logic shaped by distant inflation fears. Liquidity discipline designed for German industry, not Sahel farming. This is where the detective in the story leans closer to the evidence. Because the center of power is not where the flags are. It is where the rate is set. It is where reserves are counted. It is where permission is granted. Now we reach the smoking gun moment, the kind of paper that ends arguments. Not a battle, not a speech, a treaty clause, a central bank rule, a meeting with polite smiles and hard terms. In a back room, the language is never poetic. It is numbers. It is ratios. It is conditions. It sounds like, we will guarantee convertibility, but you will follow the rules. It sounds like, you can have stability, but we keep oversight. That is foreclosure logic. You keep the house, but the bank keeps the deed. You can live there, but you do not own the outcome. And if you miss the covenant, the lender takes control. When leaders ask for reforms, the answer often arrives as rebranding. New names, new slogans, same peg, same guarantee logic, same invisible grip. In December 2019, a reform announcement promised a new chapter for parts of West Africa. The word eco floated like a clean sheet of paper. People heard liberation again. The ledger asked one question: who still guarantees? Because the guarantee is the handcuff. If France guarantees, France claims the right to manage risk. And whoever manages risk becomes the real supervisor. That is finance. It is never sentimental. Now the climax. The default is not always a dramatic collapse. Sometimes the default is spiritual. It is the moment a country realizes it cannot fully choose its economic policy. It is when options vanish in the face of the peg. The social consequences are slow and corrosive. Credit stays expensive. Loans stay scarce. Young people with ideas cannot get capital. Imports outcompete local production. Jobs do not appear. Hope drains. And when hope drains, politics turns combustible. Protests grow teeth. Coups become plausible. Foreign flags appear in the streets not because of love, but because of rage toward the old manager. This is what sovereignty is solvency means. A state that cannot control its solvency is not fully sovereign. It can administer, it can police, it can govern the surface, but it cannot steer the engine. Now the aftermath. Systems like this do not disappear overnight. They leave scars in institutions, habits, and elite incentives. Even when rules shift, the economy remembers the old boundaries. A generation grows up learning caution. Ministers learn what topics end careers. Central bankers learn to prioritize credibility over employment. Businesses learn to trade, not manufacture. The country learns to survive, not transform. And the most tragic part is time. These arrangements are not one-year scandals. They are multi-decade grooves carved into the economy. They shape what gets built and what never begins. Ports, telecoms, rail, mining contracts, banking relationships. All of it becomes a corridor where wealth can move outward smoothly, not stolen in sacks, extracted in invoices. If you want to understand the control, do not stare at flags. Stare at settlement systems. Stare at reserve accounts. Stare at who can say yes when a government needs liquidity fast. Because when the money runs out, the speeches stop working. A country can endure insults, but it cannot endure unpaid bills forever. Salaries delayed create mutiny. Empty shelves create riots. Currency pressure creates desperation. You can feel the noir truth here. The final boss is always the balance sheet. Armies march on logistics. Presidents govern on payroll. Revolutions run on bread. So the lesson is not that Africa is doomed, or that stability is evil. The lesson is that stability without control is a cage with velvet lining. It feels soft until you try to leave. History is not decided by who gives the best speech. It is decided by who signs the clearing agreement. It is decided by who sets the exchange rate. It is decided by who owns the vault. And once you see it, you cannot unsee it. The map is not only borders, it is ledgers, it is flows, it is the invisible empire of accounting, where the gun is a contract. If you want to stay ahead of the official story, you have to follow the money first. Follow the reserves. Follow the peg. Follow the paper that never makes it into the parade footage. Subscribe to this channel if you want more financial history thrillers like this. Because the next collapse, the next coup, the next sudden crisis will not begin in the streets. It will begin in the ledger, quietly, like ink drying.